Good evening. This is the post-market recap by AGI Era. Today is Monday, February 23rd, 2026, and it is shortly after 4:30 p.m. Eastern Time, the scoreboard and technicals. The U.S. session has officially wrapped, and the price action suggests a decisive victory for the bears, with major indices closing significantly lower across the board. The S&P 500 finished the day down 1.4%, settling at 68,837.75. Technically, the index is now trading below the psychological 6,900 level, a key area that bulls had been defending. This break suggests a potential shift in momentum, and investors will be watching closely to see if this level acts as new resistance in the coming days. The Nasdaq 100 also saw considerable weakness, closing 1.21% lower at 24708.944. This underperformance relative to the broader market indicates a continued, albeit broad, retreat from growth-oriented technology stocks. The Dow Jones Industrial Average finished down by 21.91 points, reflecting the widespread selling pressure that permeated the market today. Crucially, trading volume today for the S&P 500 was approximately 2.21 billion shares. While not exceptionally heavy, this level of volume accompanying a broad market decline suggests that this move carries a degree of conviction, indicating that institutional players were actively participating in the selling rather than a mere retail-driven dip. This isn't a light volume pullback, it's a more meaningful reevaluation. Market breadth and sentiment under the surface, the fear gauge, or VIX, data for which is currently unavailable, would typically offer insights into market anxiety. However, the broad-based selling across sectors, particularly in high-growth names, suggests an underlying increase in caution, even without a direct VIX reading. We are seeing a clear divergence in sector performance. Money flowed noticeably into utilities, XLU, which managed a modest gain of 4.7%, while financials, XLF, lagged significantly, dropping 2.77%. This rotation indicates that Wall Street is positioning for a more defensive stance, favoring stable dividend-paying sectors like utilities over cyclical and interest rate-sensitive financials. This shift suggests concerns about economic growth or a potential tightening of financial conditions. The spread between these two sectors tells us that investors are favoring safety over cyclical growth. The macro engine room. The primary driver of today's moves can be traced back to the bond market, though specific 10-year Treasury yield data is currently unavailable. However, the market narrative news did highlight a slipping U.S. dollar amid Trump tariff turmoil and a reported loss of safe haven status. The U.S. dollar index, DX.F, despite the news narrative, actually edged slightly higher by 0.01%, settling at 97.65. This minor uptick, in contrast to the broader market weakness and the news of dollar vulnerability, suggests a complex interplay of global factors. While the dollar's safe haven appeal might be questioned in some circles, its relative stability today amidst equity declines could indicate underlying demand or a lack of compelling alternatives. Meanwhile, crude oil, CLF, is trading around 66.30, up 1.1% on the day. This rise in oil prices, without a clear, immediate catalyst in the news, could be a subtle indicator of persistent global demand or supply concerns, potentially adding inflationary pressures down the line. The AI and Tech Monitor. Turning to the leaders of this market, artificial intelligence and big tech today saw a notable pullback in several key players. NVIDIA finished the day up 0.96% at 191.60, showing resilience amidst the broader tech sell-off. However, Microsoft closed down 3.182%, while Apple saw a slight gain of 0.68%. Other significant movers in the Magnificent Seven included Alphabet, Google, which dropped 0.11%, Amazon, AMZN, down 2.29%, falling ETA 2.81%, Tesla, which declined 2.91%. The widespread weakness in this group, particularly the significant drops in Microsoft, Amazon, Meta, and Tesla, is notable. This isn't just profit-taking, it suggests a broader reevaluation of growth prospects in a potentially higher-for-longer interest rate environment, or perhaps a rotation out of these high-valuation names as investors seek more defensive positions. The divergence between NVIDIA's strength and the weakness in other tech giants highlights the market's selective focus within the AI theme. After hours and look ahead. Looking at the after hours tape right now, shares of Franklin Resources Ben are moving significantly, up 1.70%. This could be an early indicator of investor interest shifting towards value or financial services, or it could be company-specific news driving the move. As we pivot to tomorrow, the economic calendar does not present any major scheduled catalysts that would typically drive significant market shifts. Therefore, investors should specifically watch the SASTRT 6800 level on the S&P 500 as a critical support zone. A sustained break below this could signal further downside. The ongoing narrative around interest rates, global trade dynamics, and the resilience of the tech sector will continue to be key themes. That is your comprehensive closing update. We will see you tomorrow morning for the overnight brief. Disclaimer: this podcast is not financial advice. Data may be delayed or inaccurate. Always conduct your own due diligence.